Do not spend down one more dollar for Medicaid until you hear this, because right now, in 2026, seniors are being scared into one brutal mistake. They are told their bank account is too high. They are told Medicaid will not help until the money is almost gone. They are told to drain savings, pay random bills, buy things they do not need, or hand money to family and hope 5 years passes before anyone asks questions. That is how retirement savings disappear, not because the senior was rich, not because the senior was careless, but because nobody explained which money Medicaid is allowed to count and which money may be treated differently when it is placed in the right account structure. If you are applying for Medicaid long-term nursing home care, the account holding your money can matter almost as much as the amount of money itself. That sentence can protect thousands, and in the right state, it can protect much more than that. Because Medicaid does not look at every account the same way. A regular checking account can hurt you, a savings account can block you, a certificate of deposit can delay you, a brokerage account can force a spend down, but there are 3 account structures most seniors never use before they apply. And when they are set up correctly, under the rules of your state, Medicaid may not be allowed to count that money the same way it counts ordinary cash. Here are the 3: an irrevocable funeral trust or irrevocable pre-need funeral contract, a Medicaid-compliant annuity, and a retirement account in payout status. Those are the names you need to remember. Not a secret loophole, not a fake shelter, not a trick from the internet, real Medicaid planning structures. And if your family does not know them before the application is filed, you may be told to spend down money that could have been handled differently. The first one can help when the senior is only a few $1,000s over the limit. The second one can help when the exposed money is much larger. And the third one, in the states that recognize it, can change how Medicaid treats a 6-figure retirement account. That is why this video matters. Because in many states, a single long-term care Medicaid applicant may need to be down near $2,000 in countable assets before Medicaid will begin paying toward nursing home care. Not $20,000, not $10,000, near $2,000. And once a nursing home bill starts coming every month, families do not have unlimited time to figure this out. One wrong account can delay approval. One wrong transfer can create a penalty. One wrong assumption can turn a lifetime of savings into a forced spend down. This video is about Medicaid long-term care eligibility, not Medicare, not ordinary health insurance, not a promise that every state follows the exact same rule. Medicaid is state administered, and the details can change by state, by marital status, by the kind of care needed, and by the paperwork used. But the big idea is simple. Before your family spends money down to the floor, ask whether the money is truly countable, or whether one of these 3 accounts should be checked first. Stay with me through all 3, because each one solves a different problem. And the third one is the one families often miss because the money is already sitting in an account they think Medicaid will automatically force them to drain. If this helps you understand a rule most families only learn after the damage is done, press like and subscribe. Now let's start with the fastest account many seniors overlook. Account number 1 is an irrevocable funeral trust. In some places, you may hear it called an irrevocable burial trust. In other places, the paperwork may say irrevocable pre-need funeral contract. The exact name can vary, but the key word is irrevocable. Not funeral, not burial, irrevocable. That means once the money is placed into the arrangement, you cannot simply cancel it, withdraw the cash, and spend it on anything you want. That loss of control is exactly why Medicaid may treat it differently from regular money in a bank account. A lot of seniors make the mistake of opening a normal savings account and calling it funeral money. They may even tell their children, "Do not touch this, this is for my burial." That may feel responsible, but for Medicaid, a label is not enough. If the senior can still walk into the bank and take that money back, Medicaid may still see it as available cash. A regular account with a funeral nickname is still a regular account. An irrevocable funeral arrangement is different because the money is legally tied to actual funeral and burial services. It may pay for the casket, it may pay for cremation, it may pay for the funeral home service, it may pay for transportation, it may pay for the burial plot, it may pay for the headstone, it may pay for other itemized final expenses. And because those expenses are real, necessary, and documented, many states allow this money to be treated differently from ordinary savings. Here is how this looks in real life. Imagine an 80-year-old widower in Ohio with $11,000 sitting in a savings account. His family is told he needs Medicaid nursing home coverage, but his countable assets are too high. He is not wealthy, he does not own a vacation home, he does not have a giant brokerage account. He simply has enough money in the bank to bury him one day. But because that money is still sitting in an ordinary savings account, it may block the application. His son thinks the only answer is to spend it. His daughter thinks maybe they should transfer it to her. Both moves can create problems. Spending it on things he does not need wastes money. Giving it away can trigger Medicaid's 5-year look-back rules. But if his state allows it and the paperwork is done correctly, that same money may be placed into an irrevocable funeral trust or irrevocable pre-need funeral contract. Now the money is no longer loose cash sitting in a savings account. It is committed to a documented final expense plan. And if Medicaid accepts the structure under that state's rules, the money may no longer be treated as a countable resource in the same way. That is not magic. It is not hiding money. It is changing the legal character of the money, but the paperwork has to be right. A revocable plan can fail. A plan that allows cash back can fail. A plan above your state's limit can fail. A vague plan with no itemized services can fail. A funeral home employee may be honest and still not understand the Medicaid side of the paperwork. That is why the question matters. Do not ask, "Can I prepay a funeral?" That question is too weak. Ask this instead. Do you offer an irrevocable pre-need funeral contract or irrevocable funeral trust that is designed to comply with Medicaid rules in this state? Then ask for the written goods and services statement. That statement should show what the money is buying. Do not rely on a handshake. Do not rely on a brochure. Do not rely on someone saying, "Yes, seniors do this all the time." Get the document. Then confirm the state limit and the state rule with the Medicaid office, a certified Medicaid planner, or an elder law attorney before the money moves. The important point is this. A funeral trust usually solves a smaller problem. It is not for someone trying to protect a huge investment account. It is for the senior who is a few $1,000s over the asset line and is about to waste money that would eventually be needed for final expenses anyway. That is why it can be so powerful. The money was probably going to be spent on a funeral one day. The question is whether it sits in a countable account hurting the Medicaid application or whether it is placed into a proper, irrevocable structure your state may treat differently. That is account number one. But some families are not just a few $1,000s over the limit. They are staring at $40,000, $70,000, $100,000, money in a CD, money in a brokerage account, money from a home sale, money sitting in a joint account after a spouse gets sick. A funeral trust cannot absorb that kind of problem. That is where account number 2 comes in. Account number 2 is a Medicaid-compliant annuity. And listen carefully, I did not say regular annuity. I said Medicaid-compliant annuity. Those are not the same thing. A regular annuity can create a Medicaid problem if the contract is written the wrong way. A Medicaid-compliant annuity is designed for a very specific purpose. It converts a lump sum of exposed money into a stream of fixed payments, instead of leaving that money sitting as a countable asset. Here's the basic idea. You give a lump sum to an insurance company. In exchange, the contract pays back scheduled monthly payments. But for Medicaid purposes, the contract has to meet strict requirements. It generally must be irrevocable. It generally must be non-assignable. It must be actuarially sound. The payments usually must be equal. There should not be a balloon payment at the end designed to hide money. And the state Medicaid agency must be named in the required remainder beneficiary position if money is left after the person dies. In some family situations, the beneficiary order can involve a spouse, a minor child, or a disabled child. That is one reason this should not be treated as a do-it-yourself purchase. The exact wording can decide whether the annuity helps or destroys the application. Here's why this matters. Medicaid punishes certain gifts. If a senior gives $100,000 to children right before applying for nursing home Medicaid, Medicaid can look back and impose a penalty period. The family may think the money is gone. Medicaid may still say the transfer counts against them. A properly structured Medicaid-compliant annuity is different because the senior, or in some married couple cases, the community spouse, receives value back in the form of payments. It is not simply a gift for nothing. It is a contract, but it has to be the right contract. That is where families get trapped. They walk into an insurance office and say, "We need an annuity." The agent sells an annuity. The agent may be licensed. The agent may be polite. The agent may have sold annuities for 20 years. But Medicaid compliance is not the same thing as selling a retirement income product. If the annuity can be assigned, it may fail. If the annuity is revocable, it may fail. If the payment period is too long, it may fail. If the beneficiary language is wrong, it may fail. If the payments are not structured correctly, it may fail. And the family may not find out until the Medicaid application is already being reviewed. That is a very expensive time to discover the contract was wrong. This account becomes especially important when one spouse is entering a nursing home and the other spouse is staying at home. The spouse at home is called the community spouse. Medicaid has spousal impoverishment rules to prevent that spouse from being left with nothing. In 2026, the federal maximum community spouse resource allowance is $162,660. But couples can still have assets above what is protected. In some cases, a Medicaid-compliant annuity may convert exposed joint savings into an income stream for the spouse at home. That income can help the healthy spouse keep the lights on, pay taxes, maintain the home, and survive financially while the other spouse receives care. Imagine a married couple in North Carolina. The husband needs nursing home care. The wife is still living in the house. They have money in a CD that puts them above the protected resource amount. The family is told to spend it down, so they start thinking about unnecessary repairs, new furniture, or paying bills years ahead just to get the number down. But before they spend that money blindly, they should ask whether a Medicaid-compliant annuity could convert some of that exposed lump sum into a protected payment stream for the spouse at home. That does not mean the money disappears. That does not mean the payments are ignored. The monthly annuity payments can count as income. Income rules still matter. Share of cost rules still matter. State rules still matter. But the lump sum sitting in the wrong account may stop being the same resource problem once it is converted correctly. That is the power of account number 2. The exact action step is simple, but you must say it correctly. Do not say, I need an annuity. Say, I need a Medicaid-compliant annuity for long-term care Medicaid planning. Then ask the hard questions. Is it irrevocable? Is it non-assignable? Is it actuarially sound? Are the payments equal? Is the state named in the required beneficiary position? Does the payout period match the Medicaid rule? Will this be reviewed by an elder law attorney or certified Medicaid planner before the contract is funded? If the person selling it gets annoyed by those questions, that is not a good sign. This is not the place for vague answers. This is not the place for a sales pitch. This is the place where one wrong word in the contract can cost the family tens of thousands of dollars. Account number 1 helps with smaller excess cash. Account number 2 can help with a larger lump sum, but account number 3 is the one families often miss because they do not think of it as a Medicaid planning issue at all. They think of it as retirement money, and that mistake can be costly. Account number 3 is a retirement account in payout status. This can involve a traditional IRA, a 401k, a 403b, or a similar employer retirement plan. The key idea is this. In some states, once a retirement account is paying regular distributions, Medicaid may not count the entire account balance as an available asset. Instead, Medicaid may count the monthly distribution as income. That difference is enormous. A senior with $150,000 in a savings account may clearly be over the asset limit, but a senior with $150,000 inside a traditional retirement account that is properly placed into payout status may be treated differently in states that recognize this rule. That is why this account can be the biggest one on the list, but it is also the most dangerous one to misunderstand. This does not work in every state. Some states exempt retirement accounts in payout status. Some states still count the balance. Some states treat IRAs differently from employer plans. Some states require distributions based on a specific formula. Some states may require periodic payments that match required minimum distribution rules. Some states may use their own definition of payout status. So the sentence, Medicaid cannot count my IRA, is not safe by itself. The correct sentence is this. In my state, if my traditional retirement account is placed into the required payout status, will Medicaid count the balance as an asset or only count the distributions as income? That is the question. Most families never ask it. They call the retirement company and ask for help. But the retirement company may only know retirement account rules. They may not know Medicaid eligibility rules. They can set up payments. They can send tax forms. They can explain distributions, but they are not the Medicaid office. They may not know whether your state will still count the account balance. That is how families get into trouble. They assume a distribution is enough. They assume the bank knows. They assume the advisor knows. They assume because the money is for retirement, Medicaid will automatically treat it differently. That assumption can be wrong. Federal tax rules generally require owners of traditional retirement accounts to begin required minimum distributions at age 73. But Medicaid payout status is a state Medicaid eligibility issue. It is not always the same as the IRS retirement rule. In a state that recognizes payout status, a person may be able to start recurring distributions before age 73 if the state accepts that structure. But again, the state rule controls, not the bank, not the plan administrator, not a neighbor, not a social media comment. Your state Medicaid rule. There is also a major Roth IRA warning. A Roth IRA generally does not require lifetime required minimum distributions for the original owner. That can make Roth accounts harder to use for payout status treatment. In many states, Roth balances may still be counted as assets. So do not assume a Roth is automatically safer because it sounds more tax-friendly. Tax rules and Medicaid rules are not the same language. Picture a 74-year-old widow in Georgia with a traditional rollover IRA worth $175,000. She thinks Medicaid will force her to drain it almost completely before nursing home help begins. Her nephew tells her to cash it out. Her bank tells her to talk to the plan administrator. The plan administrator tells her they can set up monthly distributions. But the missing question is not whether monthly distributions can be set up. The missing question is whether Georgia Medicaid will treat the account balance differently once the account is in proper payout status. If the state recognizes that treatment and the distributions meet the required standard, the account balance may not be counted the same way as ordinary cash. The monthly payment still counts as income, but the full six-figure balance may no longer be the asset that blocks the application. That is a major difference. It can be the difference between preserving retirement money under the state rule and liquidating an account unnecessarily. The exact action step has two parts. First, call the state Medicaid office, an elder law attorney, or a certified Medicaid planner. Ask this exact question. Does this state exempt traditional IRA or 401k balances from Medicaid long-term care resource counting when the account is in payout status? Then ask the second question. What amount and frequency of distribution does the state require? Only after that should you call the plan administrator. When you call the plan administrator, do not say, send me some money monthly. Say, I need to set up recurring distributions that meet my state's Medicaid payout status requirement. Ask for written proof. Keep the confirmation. Keep the payment schedule. Keep account statements. Keep everything. Because when Medicaid reviews the application, they do not approve intentions. They review paperwork. If the state allows payout status and the documents prove the account is in the correct status, the account may be treated differently. If the documents are vague, incomplete, or wrong, the family may lose the argument. That is why account number 3 can be powerful, but only when it is handled with precision. Now step back and look at all 3 accounts together. The Irrevocable Funeral Trust solves a final expense problem. The Medicaid-compliant annuity solves a larger lump sum problem. The retirement account in payout status solves a retirement plan resource problem in states that allow it. They are not the same tool. They do not protect the same type of money. They do not work the same way, and they do not replace legal advice when serious money is involved. But they all attack the same danger, the Medicaid spend-down trap. The trap is believing every dollar must be spent just because it is currently countable. The trap is waiting until the caseworker says denied. The trap is thinking the nursing home admissions office is your financial planner. The trap is assuming your bank account is the only way the money can legally exist. Medicaid caseworkers review eligibility, they verify documents, they apply the rules in front of them. But their job is not to sit with your family months before the application and redesign every account to reduce countable resources. That responsibility falls on the family. And that is why so many seniors find out too late. They spend the money first. They ask questions second. That order is backwards. Before the spend down happens, ask about the accounts. Before the gift is made, ask about the penalty. Before the annuity is purchased, ask whether it is Medicaid compliant. Before the IRA is cashed out, ask whether payout status is recognized in your state. Before the funeral money sits in savings, ask whether an irrevocable contract would be treated differently. That is how families avoid unnecessary damage. There is one more warning. Not counted for eligibility does not always mean protected from everything forever. Medicaid estate recovery can still apply after death in certain long-term care cases, especially for people age 55 or older who receive nursing facility services, home and community-based services, or related medical costs. So do not hear this video as hide money from the government. That is not the message. The message is this: know the rules before the money is gone. Eligibility rules, resource rules, income rules, transfer rules, estate recovery rules, state rules, paperwork rules, all of them matter. So here's the review. Account number 1 is the irrevocable funeral trust or irrevocable pre-need funeral contract. It may move final expense money out of ordinary countable savings when it is irrevocable, documented, and allowed by your state. Account number 2 is the Medicaid-compliant annuity. It may convert a larger exposed lump sum into structured payments when the contract is irrevocable, non-assignable, actuarially sound, and written with the required beneficiary language. Account number 3 is the retirement account and payout status. In states that recognize it, this may stop Medicaid from counting the full traditional retirement account balance as an available resource while counting the monthly distribution as income. Those are the 3 accounts: funeral trust, Medicaid-compliant annuity, retirement account and payout status. Most seniors never use them because nobody says the names early enough. The family hears spend down. They panic, they pay bills, they transfer money, they cash accounts out, they make rushed decisions under pressure. Then later, someone tells them there may have been another way. Do not let that be your family. If you are caring for a parent, share this before the nursing home bill forces a rushed decision. If you are a senior with money sitting in a regular account, ask whether it is truly countable before you assume it must be spent. And if anyone tells you Medicaid will not help until every dollar is gone, ask one more question. Before we spend it, have we checked the 3 accounts Medicaid may not count? That one question can change the entire conversation. Press like if this helped, subscribe for more senior finance warnings, and before your family spends down another dollar, check whether the account is the real problem, not the money itself.